Well, commodities have been savaged as recession fears take hold. We've seen huge volatility in bonds and interest rates. We've got equities holding in for now, despite the US dollar reigning supreme. Blake and I discuss more of these factors as we go into the trade-off. Well, hi, my name's Chris Weston. I'm head of research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And we are going to be going into some of the biggest thematics that are driving markets, that are barbecue conversations. We're going to go straight into the technicals, into the setups. We're going to look at the price action and the charts that matter in our world and perhaps should be on your radar as well if they're not. And we're going to dissect and navigate ourselves around all the landmines in this market at the moment. So let's bring Blake into the program. Before I just chat Blake and talk about how things are going, if you do find yourself liking the program, give the like button a gentle tap, or you can give it a good smash if you like. But do leave a comment. Blake and I will get back to you as soon as we can, and get some conversation going on. So just head into the comments box and do that where you can as well. Now, Blake, I can see you're rocking a beard. You're looking a bit dishevelled, but very sexy. I like it indeed, and I hope to see more of that. You're looking very suave indeed. You're like the pit bull of Texas, aren't you, mate?
Of Arizona, but whatever. It's one of those things where my razor actually broke, and I haven't had a chance to go to the grocery store to pick up.
My wife hit me up the other day. We got half term here at school holidays, and she said to me the other day, she goes, "Chris, as a present to you, I'm taking the 3 kids up to Queensland, which is in the north of Australia. Do you want to stay here?" And I said, "Well, is that a question?" I said, "Yes." So if I'm looking young, radiant and youthful, it's because I've had a week now without 3 kids, which she gave to me as a present. So I think we're in different sides of the camp. You're looking like Pitbull the rock star, and I'm feeling young and youthful at the moment.
That's a hell of a holiday there, Chris. I as a parent, I can truly appreciate what your wife is doing for you.
It's amazing. Some of the best sleep I've ever had. Anyway, it's allowed me to get back into markets again. And let's talk about some of the same stuff that we're seeing. Let's go into Topical Thunder. Well, I might be sleeping like a baby at the moment, Blake, but one of the things that is keeping us awake is this idea of a global recession. Well, I say keeping us awake, it's not, but certainly the markets are seeing signs that we are going to see for more economic prolonged situations going forward. How do I see this? We've seen the 210s curve going inverted now, about -5 basis points. Obviously, copper's been we're down about 25% in this run that we've been seeing. You can go into the rates market. This is a chart that I brought up last week. You go into the euro-dollar futures and see about just under 70 basis points of rate cuts being priced for next year. So the market is expecting a pivot to happen. Certainly commodities, which we'll talk about in a second, have been getting destroyed. That's been your primary objective. And people have been hedging themselves against further downdraft by being long the US dollar, and also by being long the Japanese yen, which is looking pretty tasty at the moment as well. So, I think we're not going to get any kind of confirmation that the US and other places are in recession until the NBR actually say that, and that might not be till next year if it happens at all. But obviously the big talk of the town is this word recession. So how are you seeing this, and how are you actually trading that key thematic at the moment, Blake?
Well, first and foremost, Chris, I want to pat you on the back. Can you turn just a little? I'm just going to pat you on the back. Good job on the bringing up the recession talks last week. We talked about technical or prolonged. We had a deep discussion about this, and it seems like the recession trade has been on all of this last week. We've seen commodities really under pressure. Dollar's been ripping. As you've pointed out, even gold's fallen, which we talked about, no country for old gold men last week.
So it was a beautiful thing, man. It was a beautiful thing.
It was. I mean, it is a beautiful thing. But, I'm going to pose a question here in a bit. Has the market gone too far regarding certain things? But, this recession trade has been on, and now we're seeing, Europe really come under pressure. We're seeing the euro come under pressure because, a lot of people are asking, can the ECB match what the Fed has done and even come close or even get off the ground? And that's why the euro succumbed to some massive dollar strength as of late. So, Chris, this recession trade, I don't know if it's too early yet. But go ahead.
The problem with Europe is that all these other commodities are getting, hit. Certainly industrial metals are getting smacked, gold's getting hit. But Europe's facing this other dynamic, right, which is that European gas prices, nat gas prices are flying. They're up 100% over the last 16, 17 days. Whereas, oil prices, crude prices, US nat gas prices, they're going down. Industrial metals are getting absolutely slammed. European nat gas prices are actually going up. It's going to be a dark winter in Europe. It's going to be a really ugly winter. And the ECB need to juggle spread widening between peripheral bonds. They've got a high inflation problem, and they've got a fast slowing growth problem. You wouldn't want to be the ECB. That's the place you need to be looking for a recession. It's going to happen this year, in my opinion. It's a matter of how bad it's going to be.
Right. And obviously that's being priced into commodities, which would be our next topic that we're going to talk about is the commodities market. I mean, we've seen the absolute destruction of copper, wheat, crude. You name it, gold, even silver getting crushed. We've seen commodities across the board just getting smashed. And I guess the question I have to ask, Chris, is it's been such a swift move. As you pointed out with copper, it's like a, top to bottom over the last month and a half, we've seen, 28%, 25% sell-off in copper. I mean, is that justified? What do you think? I mean, because I mean, a lot of people are arguing that we are in a recession right now. But frankly, there's still a few things that need to happen in order for us to signal we're in a recession. And I know the Fed's probably going to end up putting us there, but we still have our jobs report coming up here at the end of this week. And, earnings are still kind of, earnings expectations haven't come down. So going back to commodities, is this move overdone? Is it over yet? Can I get out from underneath my desk? What do you think?
I mean, if you're under your desk to sleep, I'll stay under there, mate, to be honest. Sleep's a good thing. But I mean, at the end of the day, if we've priced in a lot, copper's been hit pretty hard. Iron ore, doing bits and pieces. A lot of the industrial metals have just been your first derivative of trading the recession and the global slowdown. And the Fed have told you that they're fine with creating a modest recession if it means bringing down and putting, like you say, putting the inflation genie back in the bottle. I think we've gone a long way. I think we probably get a bit of upside in the short-term industrial metals. But there's one thing that really springs to mind right now. It is the US dollar. The US dollar is a little wrecking ball that's just going around the commodities complex and just smacking things to pieces. And the one thing that we are watching very closely is obviously the oil market. And JP Morgan put out a really interesting piece yesterday, and it's not their base case that we get Brent prices going up to $190, but there's this talk out there that's been going around for a while now that we could see the US and other allies capping Russian oil at $40 to $60. And in retaliation, ex-President Medvedev has said that they potentially Russian could cut oil by 3 million barrels a day, in which case you could see Brent prices going up to $190 in retaliation there. That's something that it's not everyone's base case, but that could send markets, if it was to happen, into a tailspin. So I think that's a tail risk for markets. But apart from that situation right now, I mean, certainly industrial metals have done a lot. Give me the direction of the dollar, and I'll tell you where a lot of this is going to go. We need a weaker dollar for things like gold to go up, for silver to go up, for copper to go up. So I think it's that global wrecking ball that's the dollar, which is that's the commonality here, right?
Well, I can guarantee that we will be discussing the dollar
absolutely
at length here in just a few minutes anyway, so make sure you all stick around.
Yeah. Mate, I'll tell you what, there's the purchasing power of the average American. If you I know not a lot of you actually leave your home state, but when you do decide to go abroad, you're going to be picking up some pieces. And one of the places that might be looking quite attractive right now is the UK. And I want to touch on what we've been saying from a political perspective, because I know you've got a couple of interesting facts. You've been doing your homework. You probably know where the UK is on the map now. Boris Johnson's in all sorts of strife at the moment, isn't he? I mean, his cabinet's walked out. I think we've seen 38 or 40 members of the Conservative Party going out. It's next week we're going to see the 1922 committee coming out. And they will change the rule to allow a second no confidence vote. You're not allowed. You have to have a 12-month period between the two. There will be another no confidence vote. There's a pretty good chance he's going to lose that one. And then we're going to see a leadership battle where, I think there's a number of big candidates coming through. Penny Mordaunt's probably the favourite at the moment. But, I'll be looking at Sunak and Javid as well as potential candidates there. Javid's probably paying, $8 or so. So he's probably a decent outside bet, but it's an interesting one. The interesting one for me is the pound is expressing no political premium whatsoever. It's trading as a risk currency. I think part of that's down to the fact that the market's not sensing any kind of impending general election. It's not going to happen. There's just no reason for it to happen. So what are you seeing? I mean, how are you trading the pound? Are you being influenced by these political issues that are coming through?
Well, I am in the fact that I'm not even touching it. And as you pointed out, it's only a matter of time. But it's interesting to see Boris Johnson and how defiant he is in this situation. I think anybody else, any other leader in his shoes would have bowed out.
Well, hang on. What was the classic Neil Young saying in one of his songs? It's better to burn out than fade away. And I think he wants to go down in flames, right?
I think he does, like his hair or the looks of his hair. Anyway, sorry, I had to throw that one out there, I guess. Yeah. But the thing about Boris Johnson is I don't know how to read him, and I don't know how to read the sterling at these levels. I have colleagues that are in the UK that said, hey, Blake, I wouldn't buy the sterling with your money. And, all the rats are left the building, and you got 42 MPs that have left just today that have resigned or yesterday. Anyway, the way that you have to look at it, in my opinion, is the sterling is going to be under pressure from political uncertainty. And as you pointed out, there are certain people that might come in to challenge him in leadership. And I think you want to buy the sterling after some change of leadership, not before then, because before then, we have uncertainty, and I think the market likes certainty. So once we figure out who's going to replace Boris Johnson, I actually probably will buy the sterling for a bounce, if anything.
Well, at the moment, for me, it's trading like a risk currency. But the one thing that could see the pound outperform against like the euro and against some of the crosses and take the dollar out of the equation is that we could be looking for some fiscal stimulus to play through. Probably not until September, but the market's going to front run that. And there could be some tax relief coming through, which would actually, in theory, lower inflation. But there's a good chance that the candidates that are coming in, that we may be looking at a VAT tax coming into what could be a really pretty tough winter period, and they could give the consumer a bit of relief there. So maybe you get a bit of a bounce from fiscal stimulus. We'll see. That's an interesting one. But I don't actually think that the political situation is a problem. It's more about the risk in the dollar, I suppose.
Well, I'm glad you brought up that topic because it's a hot topic that we needed to discuss. So let's also talk about another hot topic, which will be Friday's jobs report, Chris. And I think it was last week, I believe, that we talked about how important the data is. And especially when you're talking about a recession, one of the things that's really kept us out of a recession here in the U.S., at least right now, if you're technically looking at it, even though people do feel that we're actually in a recession, is our strong jobs market. And the jobs market is this is where we start talking about how important data is to the market and to these releases and how we treat it in regards to trading the currency market or the markets in general. I'm in the camp that bad data is actually good data. Bad data meaning that data that underperforms. What's that?
Bingo.
What's that?
I was going to say. So the perverse situation, if the market's looking for 240 on the headline number, I don't have no insight where it's going to be. It's, get a dart and chuck it on a dartboard. We get 100,000 or less. Low job creation. Perversely, obviously, we don't want people to be in a bad situation. But perversely, I throw the question before you've even asked me a question. I'm going to ask you a question. If we were to get a low reading on jobs, let's say anything below 80,000, which would be well below consensus, does the market celebrate that?
I think the market does. I believe we are in the exact opposite 100-degree difference that we were last year at the same time, where we were saying, good is bad, bad is good, because people were wondering when, the Fed was going to start, raising rates. And we kept getting weak jobs. It was between weak and strong. And needless to say, we're in that situation right now that bad data would be good for markets. I think that they cheer that. Now, here's the real question, Chris. Do you think this is the month that the jobs data starts to weaken? Because I don't, actually. No.
Well, we've seen a little bit of a rise in weekly jobless claims, but I don't think that's going to be the case. But I think, if you're, I think you've got to obviously keep an eye on yields and keep eyes on 2 and 5 year treasuries. That's where the dollar's going to key off. So I think if we get a low level of job creation, say below 100,000, we were to see, depending on what the participation rate does, if we were to see the unemployment rate tick up to say 3.7, perhaps even 3.8, the market's expecting 3.6. And if hourly earnings were to come down, to be below 5%, then you're going to see yields lower, sharply lower. And I think the dollar comes down with it. Dollar yen would be a pure play there, and the Nasdaq would rally pretty hard on the back of that. We're already seeing some tailwinds to the Nasdaq, so being long the Nasdaq, probably find a better feeling gold on the back of that there. So yeah, I think you don't want a disaster number because then I think markets go, the job labor, but I don't think we're going to get that. So I think a low number. Obviously, we've see what happens with average hourly earnings, and that point. That could set off. If they were low, then the dollar falls and risk assets like equities rally on the back of that one. So, it's an interesting playbook. So, we'll have to see what happens there. You can devise a story either way. But let's go into some of the charts that are catching our mind. Let's go into that's a setup. Right, Blake, gold. It's the talk of the town at the moment from clients. Everyone's trading this one. This is probably the biggest, heaviest flow that we're seeing at the moment. And, the book now is, or certainly client positioning, net client exposure is long gold. They are now expecting a turn. Maybe that sort of comes with the idea that perhaps the dollar's seen its days, and maybe we see a bit of mean reversion playing through in the US dollar on the back of that one now. But everything for me in terms of my sort of it's not automated, but in terms of the systematic approach that in terms of having a rules-based system, for me now, I still feel that we probably go into that 1720 area. You can see that black line down the bottom. The risks are we go down into those levels. You can see the blue histogram I've got is just the rate of change. So as a momentum trader, you're looking for that vector effectively, which is saying, that it's not just the extent of the movement, but it needs a direction as well. So you've got those two variables. And right now that's saying that the probability is we go down into those levels. Now we might be a little bit oversold, but rallies are probably to be sold in this environment unless something drastically changes. So if we rally because of positioning and dollar being overloved. But right now this chart is really getting so much attention. So how are you trading this one?
Well, I'm glad that you brought this one up. And one of the common themes that you're going to hear moving forward through my charts is the 161% golden fib level. We're testing it here at 1730 today. So we went as low as that in North American trade. We got into the 1730s. If you take the mid-May low to that most recent high, just above the 200-day moving average, it takes us down to, like I said, 1730s. Will we make it down to the 1720 level? Well, that's an 88% retracement of this entire last big move from July of last year up until the highs that we recently made. So I think the 1720, 1730 level will offer some near-term support, but I agree with you, Chris. You got to sell any move back to 1800. You got to sell rallies here.
Yeah, absolutely. Yeah. I think that's the right.
But that's a nasty looking chart, isn't it?
It's pretty ugly.
It is ugly. Well, let's talk about the Euro Aussie, and the Euro Aussie is one of those currencies that I say EURAUD. You ever remember Raggy from
the fact that you're having to explain it to us is probably
it is. I know I had to explain it because that's why it's Raggy. Anyway, the euro obviously broke some pretty key levels on the euro US dollar below the 103.40 level. We went down to multi-year lows, and as a result, the euro's come under pressure against a lot of currencies.
Yeah, right.
Now, and the Euro Aussie is one of them. I believe that the Aussie is near longer term support. It's at a 50% retracement of the COVID moves. If you're a frequent guest here on the trade off, I've been an Aussie bull down at these levels. I do like it. I've bought it before at 70 cents. I bought it now below 70 cents. I do like the Aussie in as a whole, but I think it's going to outperform the euro. So I think as the euro continues to be pressured, the Aussie is going to get a little relief rally, and that's going to send that euro Aussie a little bit lower out of that. We call it a wedge, and that's coming out of the wedge. If we break below, I believe it's 149.30 on that chart. So what do you think about this chart, Chris?
I wanted to see the Euro CAD. My preference is actually to be short Euro CAD at these current levels, and Euro Swiss is one I like as well. Euro dollar, everyone's just saying 180 pips away from parity at the moment. When do we get there? No one likes the euro. The euro right now is if you've got a very shabby looking neighbourhood, it is the ugliest house on that one right now, and no one wants to be in euros. There's no reason to be there. I mean, the Aussies. The problem with being an Aussie is it's so correlated to the copper price at the moment. The correlation between the two is at 90% if you look at a 1 month rolling correlation. So if we get a bounce in copper. Yeah, I mean, this breaks that uptrend and it continues going down. Unfortunately, you've got that situation. So, yeah, I just hate the euro. I mean, I have nothing to like about it whatsoever. So, yeah, I would suggest this probably goes down short term as well. We'll see. Anyway, let's have a look at crude, because it's getting a lot of attention from clients at the moment. It's getting a lot of attention from the street. We talked about this crazy scenario that could happen if the US were to cap Russian oil at $40 to $60, and the Russians retaliate. Obviously, that affect Brent prices, but spot crude would go up, US crude would go up as well. The question is here, Blake. We've broken the uptrend. We saw that big move yesterday. Or it was ferocious, wasn't it? So 11-12% high to low, and obviously huge moves coming through. The question is can we get down into the blue horizontal level, which is basically the March-April lows, down into sort of $94, $92 is the level that we were pre-Ukraine crisis and the invasion there. It does feel like this is heavy, like it goes into 94. That's where I'd be looking for this to go over the next, by this time next week. But certainly there's a lot of risks around what we're talking about there of Russia. So where do you see this going?
Well, I actually see the 200-day moving average at the $93 level, which coincides with that horizontal support that you've got there on that blue line. And I think those are levels that are going to be tested. And like I said last week, I'm not a great crude trader, but I can call it pretty well. So and it broke down as we had anticipated. And crude, I think, is going to test that horizontal support. But you pointed it out, Chris. There is a lot of headline risk, and with what might happen with Russia and output there, could really throw a monkey wrench in any trade that you do. So, however you approach crude at this point, I think you have to do it carefully and make sure you don't let that trade get away from you.
Yeah.
I don't care what side of the trade you're on, just make sure you keep your stops manageable and tight.
The issue here is that when you're looking at the supply-demand issue, the supply issue is very bullish for crude, right? OPEC can't even meet their quotas. The curve's been in huge backwardation, incentivizing people to be long. But what we're seeing is the demand element is obviously falling away. This is part of the recession trade. You go and short copper, and that's been a really clear one. That's been where the CTAs, the trend followers, have been all over. But it's the demand side of this is holding it down. If the supply one could be changed, you could see a much sharper move down. The thing is that OPEC and other nations can't increase supply, otherwise we'd be seeing it below $80 at the moment. But it's an interesting one. I think probability is that we get to 94. Selling rallies continues to be the way to go here.
Well, I agree. I agree with you, Chris, wholeheartedly. So let's see if we can see that 200-day moving average down there in the low 90s. The next chart I wanted to bring up is the dollar index. And the first comment that I got from one of our producers was, oh boy, that's a lot of lines.
That's a lot of lines.
But what I think here is, confluence, Chris, and confluence of the golden Fibonacci ratio, the 161% extension. If you take that last big down move, well, let's just call it the first one that we saw from mid-May down to the beginning of June, then you take the next move lower, that next little, the next dip, which was actually the mid-June to the low that we saw just a couple of weeks back. If you take the 161% extension of both moves, that comes out right at the 107.35 level confluence. We got really close today, and my assumption is in European trade, while some of you are watching this show, we're going to be testing that area, and I'm going to be looking for a reaction from there. Relative strength is divergent. I've been looking for a place to really sell dollars. I have already been selling dollars for the last couple of weeks. I actually got stopped out on a couple of bad trades with the dollar regarding the euro would be predominantly one of them. But I'm still looking for a longer term top to develop. And I'm wondering if this is going to be it. So I'm looking at this area right around 107.30. What do you think about this chart, Chris?
Well, it's going up.
It is
simple. Keep things simple. I don't see enough divergence, in the RSI there to probably take that down a little bit to a 9 or 7 day RSI. Maybe you see that, but I don't see enough in there other than that it's gone up enough to make me want to go and sell this. To be honest, I mean from a rule based perspective, it's not giving me enough at the moment to give me any kind of conviction to be short. Fundamentally, it's still the hedge in your portfolio against your equity drawdown. The yen actually is a better trade for me right now. I prefer the yen as my primary hedge tool, because if you see bond yields going down, it validates the stance from the Bank of Japan. So I prefer the yen over the US dollar. But yeah, I'd like to see a bit of selling coming into the dollar to make me want to go down there at the moment. And yeah, the question is how far does the dollar pull back? And I think pullbacks are going to be fairly narrow as well. So for me, I don't like selling it at these levels, to be honest. It doesn't feel right. It's going up. So anyway, let's go to the play of the day. Let's see what's going on in our world. Right, well, I'm going back to the play of the day that I had last week, which is Euro Swiss. And we looked at the idea of being short. It's working out quite well. I want to continue to be short, to be fair. I mean, as I said, I hate everything that's going on in Europe right now. It's ground zero. There had been some talk that Putin may call a ceasefire after he gets Donbass, and that could be good for the first derivatives such as euro. But we'll have to see about that. I don't trust those headlines. I have no insight. It's not an area I have great expertise in. But that's something we are watching. And of course, this has been a very mature trend. The way that I'm looking at this now is you can see that orange line that's the moving average that comes down. That's the 8-day exponential moving average. And I'm just using that as a stop loss at the moment. You can see all rallies are being sold into at the moment. So a daily close above that level, a daily close. So the next candle flips over and I'm out of the position. But I'm holding shorts for now and I'm continuing to trend this one down. If we were to see those moving averages cross over, that would get me out of the trade as well. So I'm just continuing to stay short in this one. I think this one goes lower, and I'm just using those moving averages as my guide just to tell me when to get out of the trade at the moment. So I continue to trade this one from the long side.
Chris,
short side, sorry. Yeah.
Okay, can you turn to the side real quick? I'm going to pat you on the back because that's been a heck of a great trade. Way to go.
We make some bad ones as well, right?
Well, we all do. We're traders. That's what happens. But one I'm looking at today, and this is my play of the day, is going to be Dr. Copper. Oh, wow. And this is, you notice I put paging Dr. Copper. Did you ever own a pager, Chris?
I did, mate. Back in the day, yeah. Back in the day. I mean, they came out in the in the 90s, and yeah. So I was just
correct.
Yeah. I did.
I had one in the early 90s as well. Now we're gonna page the doctor here because, as we pointed out earlier in the show, Chris, a 25% move lower in this last leg. Copper's hitting the 161% extension. Again, the show is littered with the golden fib levels. They're all testing. And because I think that copper and other commodities might recover because they went a little bit too far on these recession fears, I think as commodities bounce, we're going to see the dollar pull back a little bit. But I want to see how the copper reacts here because we did get a hammer, pin bar, however you want to look at it. We got a nice reversal candle today. So let's see how it performs tomorrow.
I think that candle is a really interesting one as well. You need it just to break through that high, but it's told you that we could be at a bit of exhaustion in that selling. The market's unsure about pushing this one lower. So I like that as well. Again, it's going to be the king dollar that drives that one, I think, break. So an interesting one. I want to just put out that next week, of course, we've got US earnings season starting. We've got JP Morgan coming out, and that could be a volatility driver. You're going to listen to a lot of these companies telling you how things are actually going on. We're going to be listening out for supply chains. We're going to be looking for is there any kind of any kind of easing of supply chain issues coming through? What's their view on the dollar? What's going on with China? There's a whole factor that we're looking at. So keep your eyes on that. We didn't touch on that today, but I think that's something that could drive global markets as well. Anyway, that's all from Blake and I hope you've enjoyed the show. Do hit the like button if you stayed on to watch it. Leave a comment and we'll see you back next week for more, where we've got a special guest on there as well, which I think is going to be really interesting to hear some of his thoughts as well. So we'll explore more of that later on. Anyway, see you for next week.